So now we're going to explain our long call strategy in greater detail. So this is an overview of what we're going to cover, but you can look at it yourself later on, and we'll move on. Okay, so the long call strategy. You're absolutely bullish on the stock. You want the share price to rise in order for you to make money. It's a debit, it's a cost to this trade. You have to buy it a little bit like buying a stock, you have to buy a call option. It's much better placed when implied volatility is low. We'll explain more about that later on. And give yourself plenty of time for the trade to happen. So how do you actually go about constructing this trade? Well, you've seen it live already. But you simply buy a call option at a strike price. Now, we prefer in the money. You can go at the money or out of the money if you want. At Share Navigator, we prefer in the money because we like to buy as little time value as possible when we're buying options. Because time value is expensive and it means that your break even is higher. It means the share price has to rise more the more time value that you buy. But you could be a different type of investor. So the Apple trade we just did, you can see there on the 2nd of October it was trading at 110.11. We had two choices. We could actually buy the shares or buy a call option. Our target price for the stock is 150. And we've decided to buy the call option, and you've seen us doing that. We bought one call option contract which expires in January 2017, so we're giving ourselves a year and 3 months for Apple to rise, and we bought the $95 strike. So what did we do? We bought the right to be able to go and buy 100 shares of Apple at $95 between now and January 2017, and we paid out $24 per share or $2,400 per contract. And the reason it's $2,400 per contract is that one contract controls 100 shares of stock. So please note, we only trade options that are highly liquid. In other words, there's a lot of volume there and the bid-ask spreads are pretty low. Just be aware of that. So what's our risk in this strategy? Well, our risk in this is the amount we paid for the calls. We can't lose any more than what we paid out. And that's $2,400. And you're going to see how valuable that is when we compare it later on versus actually buying the stock outright itself. What's our max potential profit? Well, it trades like a stock, so your profit potential is actually unlimited. The further the price of the shares go up, the more the value of your option goes up. But remember, we had a target price of 150. So we're going to base our calculations on the fact that the share price gets to 150 and we sell. Now, there's one other element you need to be aware of. The profit would also depend on the proximity to expiry and the time value left in an option. So if you remember, options have real value and time value. And if there, for example, there's 6 months left and the share price has hit 150, there's going to be some time value in this call option. So you're going to have to add that into your calculations. But for the purposes of this presentation, we're going to assume there's no time value in it. So we're actually going to hurt ourselves a little bit on this, just to be clear about it. So we're going to assume it's now January 2017 and the share price has just got to 150. So there's no time value left in the option. So therefore the value of our call option is the in the money portion that's left. So if the share price is trading at 150, we have the right to control the shares at 95. That means the value of that call option contract is $55. We paid $24 for it, so our profit is 55 minus 24, which gives us $31 per share in profit. How do we calculate our return on investment? Well, our return on investment is your profit or your loss divided by your investment amount. Well, we know we've made $3,100 in profit. We know we invested $2,400. So 3,100 divided by 2,400 gives you a return on investment of 129%. Again, when you actually see this compared to buying the stock outright, you'll see how beneficial this really is. So what's our break even? This is the downside of buying call options. The break even for a long call option is the strike price plus the premium paid. So for our Apple trade, our strike price was 95 and the premium we paid was 24. So our break even for this trade is that at expiry Friday, the price of Apple needs to trade above $119. And that's the downside of buying call options, because remember the share price was trading at 110 today. So it actually needs to rise about $9 between now and expiry in order for us just to break even. So that's the downside of actually buying calls. Your break even is actually higher. Having said that, don't forget if the shares do move up, the delta moves up as well. So in the short term, you can still make a profit if the shares only go up $1 or $2. But assuming we're now at expiry Friday, you're waiting to hit your target price, it needs to get over 119. So what are the effects of volatility on this long call strategy? It's best to buy options when implied volatility is low, and the reason is the value of time is less and you're not paying as much for the option. Thereafter, the effects of volatility depend whether the call is in the money or out of the money. So the proximity, it really does depend as to where the share price is trading at. Usually implied volatility will add to option premiums. So as volatility kicks up, usually the value of options go up as well. But don't forget, if share prices fall substantially, the value of your option is going to go down no matter what happens volatility. So what's the effect of time decay? Theta. Well, theta is negative for option owners. And if you remember back to our trade that we placed, the theta was 0.016. So that means that every day between now and expiry, the time value of that option will decay by 1.6 cents every day between now and expiry, just the time value. So please note that theta can change from day to day. And what about the effect of delta? Well, this is going to suit some of you guys who are more interested in shorter term trading. So for every $1 rise in the stock, the delta was 0.7. That means the value of the option will rise by 0.7. So for example, if tomorrow Apple rises to 111.11, which is $1 higher than where we bought it, or when we bought the option, the value of our option should be worth 24.70. Okay, so that's where you use your deltas to calculate shorter term moves in the options price. So what about in general? How do you go about picking the strike prices and the time frame? Well, the strike price is down to really the degree of bullishness that you have. If you're really bullish in a stock and you definitely think it's going up, well then you could buy at the money calls. They won't cost you as much money, but you're going to pay a little bit more in time premium. But on the overall cost of things, it's going to be less. If you're just bullish, then use in the money strikes like we use. So in the money strikes, remember, for call options is when the strike price is trading is below the share price. Personally, I like in the money calls because I'm not buying as much time. That's just for me. And my rule of thumb is having a delta over 0.7. With our Apple trade, we went in the money by $15.11. Remember, it's the share price minus the strike price. In terms of what time frame you pick, go out as far as you can. Give yourself as much time as possible for this trade to work out, especially if you don't have that much time value or you're gone well in the money. You can afford to wait for this thing to rise because your deltas are so high. So just in terms of managing the trade, if the share price target is reached and you want to sell, just sell the call option for a profit. That's typically what you do. You just sell the call option. You don't bother exercising your right to take the shares. You just take the call option. If the share price falls below your strike price, it really depends on your outlook for the stock. If you still think it's going to go up, do nothing and give it a chance to work out. If not, it's changed to a new lower target price, and then you got to look at selling maybe at a slight loss in the position. It's as simple as that. So managing this trade is all about selling these call options just before their expiry. If you have any questions on this strategy, please contact us. We're going to go on there now and talk about the profit and loss tables and also compare the long call strategy versus actually buying the stock and what's the pros and cons of each strategy.